Hi everybody, Jennifer Schonberger here with smallcapinvestor.com. The equity markets have been nothing short of tumultuous this year, as the companies have dealt with a slew of challenges, most notably including frozen credit, rising energy prices, a debilitated consumer, and now a weakening economy. But through all of this rubble, there are investments out there, and one such investment is Stanley Inc. The company provides IT services to U.S. defense and civilian federal government agencies. And what better person to talk to about this company than the company's CEO, Phil Nolan. Mr. Nolan, thanks for chatting with me today.
Thank you. Thanks for having me.
I understand you're in the midst of finishing up your second quarter of fiscal 2009, and you initially gave guidance for the full year and the second quarter in your first quarter press release. Has your guidance changed at all since that time?
Well, we don't typically update our guidance after our initial earnings call for the quarter, but I can tell you that we continue to track very well in terms of the business opportunities that we thought we'd be able to bid and win, and also new opportunities we have coming down the line. So I'd say that overall for the quarter and for the year, I think we continue to look pretty strong.
Sure, and let's talk a little bit about those driving forces behind your results. What is your visibility into task order wins for the remainder of the year?
Well, we have a very strong, what we call qualified pipeline of opportunities. That means things that we've looked at that we think we have a very good chance of bidding and winning on that are sitting out there. Obviously, we work on responding to the government's request for proposals, and then after that, we have to wait for the government to actually make the award. But I could say that the bid pipeline that we have is very strong, again, with the number of opportunities that we have submitted, and we think that we'll see significant activity on that, both by the end of the government's fiscal year, which comes up in just a week, and also by the end of the calendar year.
Okay, sorry, just to press you a little bit on,
Sure.
on the guidance. Given that you probably have a rather full pipeline going forward, would that create greater upside to your current EPS guidance for the remainder of the year?
Well, that's a great try. I think we'll stick with my previous answer in terms of updating the guidance and stick with what we've got. But obviously, as we look at the guidance for the year, and we're still fairly, we're just about reaching the midpoint of our fiscal year. Mm-hmm. And when we put our guidance together, we try to work on putting out there various scenarios that would get us there. Mm-hmm. Meaning that everything doesn't have to happen serially. We can have different things happen, some losses that we didn't expect, some wins we don't expect to help get us there. And right now, we feel pretty good about the numbers that we've put out.
Okay, sure. You recently acquired Oberon Associates. What sort of synergistic benefits, both in terms of garnering market share and new customers, as well as revenue and earnings accretion, do you perceive that you will garner from this acquisition?
Well, first, as we look at acquisitions, the thing that we're looking for is, from a characteristic standpoint, is somebody that can add new technical capabilities for us, new customers, new contract vehicles, somebody who is growing at least as fast as we are or faster, somebody who is at least as profitable as we are or more profitable, and someone that we can make accretive within the first year. And we think that the acquisition of Oberon hit every one of those categories for us. In addition, you talked specifically about the customer synergies that we got. From that acquisition, every customer we brought in is new. We had almost no intersection whatsoever with the customers that Oberon brought in. So from that, it's a very good deal from a standpoint of bringing in those new customer sets that we didn't have before.
Sure. And what about in terms of accretion on the top and bottom lines? Do you have any number in mind in terms of how much that might add?
Well, I think when we talked about the acquisition initially, we said that people should expect somewhere between $80 and $85 million for our fiscal year in terms of what they would add from a revenue standpoint, and we also said that we expected them to be slightly accretive to earnings at the end of our fiscal year.
Okay. Besides the new task orders and the Oberon acquisition, what other catalysts or factors will drive Stanley's performance in 2009?
Well, as we look at 2009, obviously we've talked about the qualified pipeline of opportunities. It's very big, sits at about $4 billion right now. But if you look at some very specific catalysts that we have out there, we think that going into FY09, the continued demand for passports from the American public will be strong. The reason why we think that's going to be strong is because of something called the Western Hemisphere Travel Initiative, which says that American citizens have to have a passport to travel to Canada, Mexico, the Caribbean. Mm-hmm. The requirement for air travel went into effect in January of 2007. We saw a very big surge when that came into place. The requirement for land and sea ports of entry go into place in June of 2009. And so we expect to see a ramp of demand coming up to that deadline and for some period after that as people get passports for that. Sometimes people would say that that demand might not be there because it's tourism driven in terms of getting passports, but we think when you talk about especially the land ports of entry, we're really talking about commerce, people who go back and forth across the border every day to do their jobs. So we do think there will be pretty strong demand in '09 for that.
Okay, what are your strategies to bolster near-term and long-term growth?
Well, as the goals that we've put out there to everybody for growing the company, we've said 10 to 15% organic is what we want to do. That means things that we're able to win as a company ourselves, and then supplement that 5 to 10% with acquisitions. And from a long-term strategy standpoint, this is what we expect to continue to execute on. As we look at, I've talked about Passport. Army Equipment Reset is another big area that we think will be a growth catalyst for us as we go forward. Equipment Reset talks about the process of taking equipment that's really been used up or beat up in Iraq and Afghanistan and bringing that back and making it fully ready to fight a war again, if you will. And we expect to see a big surge of that in 2009 and beyond. And so if you take Passport and Equipment Reset, those are two areas really in the short and medium range that we expect to be good growth catalysts for us. Beyond that, you start looking at where we think priorities might be with a new administration. Obviously, there's been a lot of talk about healthcare reform. Healthcare IT is something that might be a catalyst. You look at immigration reform as something else that's been talked about. So those are things that come beyond the Passport and Reset as far as areas that we're looking at.
Speaking of the presidential election, given if a Democratic president were elected into office, how would that affect your company?
Really, as we look at both of the candidates that are running right now, I think that our job is to serve the government, and we'll serve whatever government is in power, whether it's Republican or Democrat, obviously. But as you look at the priorities they have, I don't think that there'll be a whole lot of change to the space as we go forward. There's been a lot of talk about necking down, if you will, on weapon system procurements, those sorts of things. Not really the type of work that we do. We are more on the services side of the business. So these are the things where they ask us to get more out of what they already have out there existing. So I don't think there'll be that big of an impact regardless of the administration that we have in place.
Mr. Nolan, what is your current market share compared to a year ago?
Well, we really don't talk in terms of market share, I guess. But to give you an idea, I mean, last year we did about $600 million in revenue. This year we're on track to do certainly better than $750 million in revenue. And this is in a space that you can get all sorts of numbers to how big the services space is in the government marketplace. But that number is somewhere in the order of $200 billion. So if you look at it in that terms, it's pretty small, but that means we also have an awful long way to grow.
How do you plan to maintain a sustainable competitive advantage in the industry?
For people who are in the services space, the most important things we can do is have terrific past performance. That means that we deliver on every contract that we execute on. We do what we said we'll do on budget and on time, and also be very competitive from a cost standpoint. I think those are the two things that we look at constantly, that we're very focused on to make sure that we're always satisfying the customer and that we're always coming at the best price we can. And if you do those things, I think that positions you very well in this space.
What are some potential barriers to continued growth?
Well, you talked about the elections, and you looked at things like that. So you never know what's going to happen with priorities until someone really gets into office, and you also don't know the effect of. We have the financial situation that's going on right now that could also put a crimp in the credit markets, obviously. And if acquisitions are part of our strategy, then that's one of those things that if you can't borrow money, then that makes an acquisition strategy hard to execute. I think all of these things will be sorted out, though, as we go forward. Are
you in any way affected by the credit crunch out there? Has that materially impacted your business at all?
No.
Will you be going back to the equity markets anytime soon, or on the flip side, repurchasing shares?
Probably no to either one of those things. I think that obviously the last deal we did of Oberon Associates in July, we levered the company up. If you look at the total debt we've got out, it probably sits at about $200 million roughly as we sit, and that's probably at about less than 2.9 turns on EBITDA for the company. I think that we're able to cash flow that debt off. So right now there's no imperative to go back out to the markets to raise money through equity.
Okay. Mr. Nolan, the clincher question, if you will. If I were an investor and I was looking to deploy capital in Stanley Inc., what would you say to me? What is the key to Stanley?
Well, there's several things there, but I think that the bottom line answer comes down to Stanley is not a trust me story. Stanley has a proven track record of growing the company organically, a proven track record of doing acquisitions, successfully integrating them in the company, and a strong, stable, tenured management team. We've all done this for better than 15 years. We've all done it together. The same team that's grown us to this part is going to be the team that grows us going forward. So I would say that all of the pieces for Stanley's continued growth are in place.
Okay, great. Thank you very much for your time today, Mr. Nolan.
Thank you.
And for more on Stanley Inc., please read my spotlight on smallcapinvestor.com.